Balancing traditional and non-traditional assets in your retirement portfolio is crucial, especially if you're looking to protect and grow your wealth as you approach or enter retirement. Most of us rely on traditional assets like stocks, bonds, and cash, but in today's unpredictable market, these alone may not be enough. If you're serious about making sure your savings remain safe and profitable for the long haul, you'll want to consider a more diversified approach. Now, when it comes to balancing these assets, the key is finding the right mix. Traditional assets are familiar, things like stocks, bonds, and cash, which are still important for providing liquidity and potential growth. But the reality is, these types of assets are more vulnerable to market fluctuations and inflation. As a retiree, you can't afford to rely solely on traditional assets when the market goes through its inevitable ups and downs. This is where non-traditional assets come into play. Real estate, commodities, and even cryptocurrencies have emerged as viable alternatives. But let's face it, real estate can be tricky. Managing properties and dealing with market volatility isn't always ideal. Commodities like gold, on the other hand, have a long history of maintaining their value, especially during times of economic uncertainty. If you're interested in learning more about why thousands of Americans are choosing to protect their wealth with gold IRAs, click the first link in the description to get our free guide. It's a great resource for anyone serious about diversifying their assets and securing their retirement. When you're diversifying, you want to think about how each asset works in tandem. For instance, gold acts as a hedge against inflation, making it a perfect complement to your traditional assets. The beauty of adding gold to your retirement portfolio is its ability to move differently than stocks and bonds. When the market crashes, gold typically rises in value, providing a buffer for your savings. This is especially true if you're looking at gold IRAs, which allow you to invest in gold without the hassle of owning physical gold. Now, you might be wondering how much of your portfolio should be allocated to these non-traditional assets. It really depends on your personal financial situation, but experts often recommend keeping around 10% to 20% of your portfolio in non-traditional assets, with the bulk in traditional ones. However, for those of you with larger portfolios, whether it's 100K or even 5 METs, you may want to increase your exposure to things like gold IRAs, which can help protect against market volatility and inflation more effectively than stocks or bonds. In addition to gold IRAs, you could consider other alternative assets like private equity, fine art, or even peer-to-peer lending. But remember, the key here is balance. You don't want to put all your eggs in one basket. Gold IRAs, however, stand out as one of the most stable and secure non-traditional assets for retirees. If you're ready to take action, I highly recommend checking out the first link in the description. It will walk you through everything you need to know about protecting your wealth with a gold IRA, especially if you've got 100K or more in your IRA or 401K, or even up to $5 million in savings. To wrap things up, balancing traditional and non-traditional assets in your retirement portfolio is all about minimizing risk while maximizing potential returns. Gold IRAs are one of the best ways to protect your wealth, especially when you've got significant savings. It's not just about growth. It's about stability, security, and ensuring you don't outlive your money. For those of you who are ready to take that next step, click the link in the description to get your free guide today. This is a perfect opportunity for American retirees who want to protect their retirement savings and safeguard their wealth. If you're serious about securing your financial future in the next 2 weeks, this is the time to act. Don't miss out on this important step toward financial peace of mind. Thanks for watching, and I'll see you in the next video.